Okay, well, good afternoon. I'm Amy Nitschke with the Wisconsin Restaurant Association, and I want to welcome you to our session on Understanding Cash Flow 123, led by EWH University. This session is the first of a three-part series. The Restaurant Insights Summit webinars are sponsored by Society Insurance, a great partner of WRA's, providing our members with a variety of cost-saving solutions. These webinars are hosted by the Wisconsin Restaurant Association, dedicated to the success of the food service and hospitality industry. WRA serves as your primary resource for regulatory guidance, training opportunities, and solutions to relevant challenges. A couple of housekeeping items before I turn things over to our speaker. Feel free to submit questions using the chat box or the Q&A feature found at the bottom of your screen. We'll get to most of your questions at the end of the session. The webinar will be recorded and sent to you in the next day or two. If you would please answer the quick feedback questions after the session, it would be greatly appreciated. Also, around noon today, in your email, you should have received a PDF from me. And if you have that handy, you want to pull up that email, please do so. And you should have that at your fingertips for this session. But don't worry, if you don't have it handy, I'll resend it to you again after the session. I will now introduce our presenter. I'm excited to have with us today Joseph Hastreiter, partner at EWH Small Business Accounting. As the son of a small business owner, Joseph would sit around the dinner table as a child and hear how much his father, Ed, helped organizations grow their businesses. Fast forward to today, as partner of the family business, Joseph has led the marketing and sales departments while helping over 1,000 business owners achieve the knowledge and tools to run their small business through the EWH University. With certifications in coaching and 5 different talent assessments, Joseph does whatever it takes to find new ways to help small businesses reach their best potential and get results. Joseph's passion and experience is what has helped him build EWH University, a single source for critical information, tools, skills, and support that business owners need to achieve success. Joseph, I will now turn this session over to you.
Thank you so much, Amy, for that warm introduction for all of us and welcoming in. And a big thank you to the Wisconsin Restaurant Association for everything and helping put this together and our partnership that we've had. And we have a great session in store for all of you today. If you're here with us today, you're obviously aware that our session today is called Understanding Cash Flow 123. And on that note, let me just share my screen here so you can follow along. And the other thing is, I'm going to put this in a slideshow view here for a minute. And just to reiterate, actually, while I'm sharing my screen here in a moment, this was the PDF, what it looks like that Amy was talking about. Really want to encourage you as we go through this. When we get into a couple slides, I'll tell you what we'll be starting on page 2 that you see here. You're going to be learning a lot, so take a lot of notes. You'll have that resource there. We'll share with you more resources, especially when we get to the end today, about how you can continue your progress and momentum, and some other resources there as well. And then also, if you have any questions at the end, we'll get to them there as well. Again, do want to encourage, put them in the chat or the Q&A feature. As we go through some of these parts, I will try to check in with some of those. We, again, may leave those to the end to touch base on, but most important thing is to get your outcomes, your questions in to really help you learn today's information no matter where you're at. Some people are much more comfortable with their numbers and they're here to continue learning it and mastering it. Other people, this is a very unfamiliar area with them. So no matter where you are, we're going to make this super simple, easy, and fun today. We're starting from 30,000 feet. And as we'll talk about how these other sessions will flow here in a moment. So again, this is the handbook to kind of have out next to you as we go. And then to start the PowerPoint here, let's jump into it. So this session is called Understanding Cash Flow 123. And to give us our roadmap about how this session fits into the next 2 that we're going to have, and we'll touch on those, and those are on the WRA website again. Want to encourage you to sign up for each one of these. Each one of these can be taken independently, but also there'll be momentum each one of them. Today's about understanding cash flow 123, starting from 30,000 feet, talking about the cash flow track, how to implement a numbers-based strategy, understanding the main scorecards you have, and getting familiar with navigating these maps as a metaphor. Then in the next session, and this was even a question I know one of you kind of sent to the WRA beforehand, is are we going to be talking about some of the key performance indicators associated with restaurants, like for food and labor costs and operating expenses and some of those key numbers? And the answer to that is absolutely yes. And while we'll be slightly touching on KPIs today, going into the next session is really where we're going to talk about those specific numbers for restaurants, food cost and labor cost. The short answer to some of that right now is it depends a little bit on what type of restaurant you have. And when we get into that on the next session, we'll talk about it. And really what we're going to do though there is talk about how to use your numbers to quickly set and reset sales and profitability goals. And this has been so important. The restaurant industry, as you guys all know, has been one of the most impacted by COVID-19. And what you're going to learn starting today and in the next session is how to quickly look at your financials. And I mean, when I say quickly, how in 10 to 15 minutes, once you know where some of these numbers are, because with sales jumping up and down and people having to adjust operating expenses and scheduling and everything that comes with that, there are some ways to quickly reassess what's your break-even point and kind of relooking at things about what do some short-term goals need to be or long-term, so you can kind of continue to figure out how to maintain and thrive throughout all of it, and be able to have some of these benchmarks to calibrate, make some new decisions, and then get right back into it. And then, it's also how do we make this happen with our numbers, and that's really our team and our customers. We're going to talk about the 4 paths to superior service and the DISC behavioral model a little bit to help us better understand our customers and our employees. And I remember talking to a very successful restaurant manager in the state of Wisconsin, and he was like, why are some customers so demanding while others are so friendly and accommodating? And we'll kind of get into that there, and also what can show up with our team member to give you some insights on how to provide superior service, whether it's internally or externally. So in understanding cash flow 1, 2, 3, we'll learn how to navigate these maps. The next session will be setting and resetting sales goals and profitability with quickly understanding our break-even point and how to adjust accordingly. And then those 4 paths to superior service. So they'll all kind of tie in together. And again, more specifically on our roadmap today, follow along in the handout, take notes. You're going to be learning about how to implement a numbers-based strategy. We'll also talk about these 5 critical accounting mistakes that can sometimes also get in the way in the cash flow track from 30,000 feet. How does cash go in and out of the business? And then we're going to make a direct link to the balance sheet and income statements about where they show up on the track, how cash comes in and out, to be able to help you better manage it and so forth. And then the KPIs we'll start on today and get into a little bit more detail in the next session. Now, with all that said, I know that might have been a lot of information, but again, we're going to start from 30,000 feet and keep this super simple and easy for you. Because the reality is what we're going to talk about today is simple, and sometimes implementing it isn't exactly easy. But simple and not easy is a lot better than complex and not easy. Complexity is the enemy of execution. So we're going to make this very simple and digestible, make sure we can answer your questions, and you guys can get some real value and traction out of what you're going to learn here during these sessions. Okay, so let's talk about briefly what is implementing a numbers-based strategy. And this is going to be on page 2 in your books. You can start following along there as well. And briefly, what you're going to see up at the top there is a desired financial destination. And this is having a budget or some targets back to like what you want food costs, labor costs, or operating expenses to be. And then we have to go out though, and navigate the territory. It's not just as easy as knowing what those numbers and those benchmarks need to be. We have to deal with employees and customers and paying vendors and everything that comes with running a business and managing the day-to-day operations. And what that's really all about is execution. And then from there, you're going to have your bank statements, credit card statements, POS reports, maybe your loan statements. And all those things are a series of transactions in your business. And where accounting really comes into play is accounting needs a sound reporting system, whether you're doing it internally with yourself, or maybe you got a bookkeeper or working with an outside accounting firm. You need some simple ways to know that you're gathering all the information you need at the end of the month to be able to then put it together in this accurate and timely scorecard. And that's just really simply put your financial statements, right? And they're really just a scorecard with a piece of paper and some numbers on them. And we're going to make that simple and easy today. And then the next step is understanding the story your numbers are telling you. And this is the part that can be a challenge, is be able to actually look at our financial statement, read and understand the story, and then compare it to our desired financial destination, make a new decision or see where we're at, and then jump right back into navigating the territory. And this is important because as we go through this session today and we cover these 3 scorecards, one of the things we're going to encourage you to do between this and the next session is pull out your scorecards. And with what you're going to learn today, get comfortable just navigating where numbers are on the balance sheet and the income statement. Then when we jump into the next session, what'll happen is you're going to, be able to review your financial statements quickly over time. So you can spend 15, 20, 30 minutes a month. It's once you're more comfortable with it. You'll know where your key numbers are, what new decision you need to do or what you need to improve the next month. And then you'll be able to jump back into your business and help lead it to the financial results you're looking for. That's always just important because sometimes we stay stuck on this planning stage or we get so focused on that. And what we want to be able to do is, actually, let me just jump to this slide for a minute since we're kind of talking about it here, is, you want this to eventually turn into like your GPS system on your phone. And we're going to talk about this as a metaphor today, but your financial statements are just really like your financial GPS system. And once you know where your key numbers are, where you want to arrive, you can just take out your phone, look at your financial, and it'll be easier for you to navigate and know what you need to do to get from A to Z. That's one reason why we call the second session setting and resetting sales goals, because with all the volatility going on, having the flexibility to see what variables are changing quickly and quickly run some formulas can really help you understand what direction and what you need to focus on to be able to improve your situation and do what you can to be able to influence it. Because there's been so much out of our control with everything going on with everyone during COVID, and just having some of these insights can allow us at least to feel that we have some influence over our situation when everything in our environment can seem out of control. So that's kind of metaphorically what we're going to be going for here today. And again, right, this process of implementing a numbers-based strategy should be happening every single month in your business. You report your information, you get a financial back, you compare it to where you want to be, food costs, labor costs, operating expenses, some of the other numbers we'll talk about today, and then you can get back to doing it. So that's kind of an overview of implementing a numbers-based strategy. Also, I'd encourage you as a resource, if any of you haven't picked up the book on the right, The Ultimate Blueprint for an Insanely Successful Business, it'll give you great insights and resources to further understand your numbers and lead your business by the numbers. And also real quickly, Keith Cunningham is Rich Dad and Rich Dad Poor Dad, for some of you that are familiar with that book. Rich Dad Poor Dad is one of the best personal selling finance books of all time. And Keith is Rich Dad in that book. He's brilliant, and he's wrote a new book called The Road Less Stupid, because he says if we can just make less stupid decisions, how much more money would you still have? Anyway, he's brilliant, and his book's got, I pretty much say it should be people's business Bible. It's got 40 to 50 chapters. They're all really short on key things, experience that he lived. He's an unbelievable teacher with how he goes about it. So I really want to encourage you to pick up some of those resources there as well today. So with that said, let's start from 30,000 feet. And by the way, if you do for some reason have some questions so far, put them in the chat. Just kind of a way to check in to see how you guys are doing. I will be able to glance at them. We might again touch them at the end. I want to encourage you as you go along, if you do have questions, to put those there so we can have an interaction. This is a little bit different in a webinar format. We still want to be as interactive as possible. So on the cash flow track is perfect. Just wanted to check in with time here, so we're doing great. And on the cash flow track, what we're going to be focused on briefly here is what's on the right. So you can see, right, to get a business started or any place, cash is the lifeline of any business. So it starts with cash at the intersection. Then ultimately, usually, right, we either have to borrow or finance money, right, to get the business going, or like PPP loans were a great example during COVID with the government providing support with everything was going on. But cash can come in through financing in different ways. Sometimes the owner puts it in, sometimes you get that through a bank and so forth. But ultimately, we need to utilize that financing to purchase assets. This is the restaurant build out, all the kitchen equipment, right? All of the equipment that's going to be utilized in the process of servicing our customers. Where the customers come in, they experience the atmosphere and the ambiance and everything that goes into that process. And then our customers ultimately generate all of our revenue, though. And sales are revenue. And by the way, you'll hear other terms that accountants like to give 3 or 4 names to, just to keep us all on our toes. So don't let the different terms they can use like sales or revenue confuse you. It's just all sales. Then at this part of the track here, and Amy, can you see my mouse, just so I know? Okay, good. So mouse is kind of like a pointer clicker, so I appreciate that feedback, Amy. And at this point of the track here is where you're going to pay your bills, manage your expenses, because expenses reduce profits. So understanding, where your food cost, your labor cost, and your other costs are key to understanding how you arrived at profitability. But what we also need to know is that just because our business is profitable doesn't mean we have cash. Because when we get back to this portion of the intersection, we can distribute some of that cash out of our business and income comes into our household. But that's one decision we can make. Sometimes we have to pay off debt. Sometimes we have to buy new equipment. Sometimes we put it into sales and marketing with the hope of growing our customer base and our sales activity, which then we hopefully grows profits and cash flow. But when we get back to this intersection, we have one of those 4 choices: distribute the money to our household, pay off debt, buy equipment, put it into sales and marketing, and what we're going to do with it. And you're going to see that when we go through these scorecards about where each scorecard is on here. But this is how cash can come in and out. And this is also why our profit that we have left sometimes result in very little cash left in the bank. For example, when you borrow money from the bank, it's not sales or revenue. So when you repay the bank, it's not an expense. It reduces your cash position, but you're paying back the note. And yes, the interest portion is an expense, but not the principal portion. That's just one small example of why our cash position and profit position can be so different. So being able to have some insight with what our financials will tell us with some of these different spots along the track is key to managing and measuring our results, because we can't manage and lead or we're not measuring, reporting, or tracking. And also in this process, accounting can be very confusing. Numbers can be very confusing. This will again help make it simpler, and simpler is much, even though it's not easy, is better than, not simple and not easy. Okay. So let's then check on where just done time here. Perfect. So let's dive in then. Quickly cover on these 5 mistakes, and also if you're in your book, you can probably take some notes on page 3 on here. And the other thing, just so you guys know, and we can include this link for you after class, but there is an article on our website very quickly that is on these 5 critical accounting mistakes. So there's another resource here as well for you guys to help reinforce some of this. So you can take some notes on page 3. And we did just get covering on page 4 that cash flow track there as well. So real quickly on these 5 accounting mistakes is the first thing, the mistake that businesses can make is mismanage the company checkbook, or they're running their business by their checkbook. And this can be a challenge because, as you'll see here when we go through these scorecards, there are so many other ways in the result of how we can end up at our cash position. Where is it going for expenses? What percentage of sales it is? Are we buying new equipment that we need? Are we paying down the loan? There's a lot of things that can impact that checkbook. And we'll see very quickly how we need all these other coordinates in our financial GPS system. And that's really where the number 2 mistake comes in. We saw this on implementing a numbers-based strategy, the reporting system on the bottom, right? And that's really having an accounting system in place so you're organized and streamlined. You know what information you need at the end of the month to gather to then put the financial statement information together. And that helps monitor all the cash coming in and out that we saw on the cash flow track. That's really the purpose of the accounting system, is to be able to report and manage all the cash that's coming in and out. Then obviously not understanding your profit or cash position. That's also partly what today's about, with reading and understanding our financials. We touched on a little bit on the cash flow track. And then also there's this unintentional credit card usage with mixing business and personal expenses, which is then also kind of related to mistake number 5, which is a lack of an audit trail for receipts and invoices. And put simply, you need to keep your receipts, the bank statement, credit card statement, and then your number shows up on your financial statement. But that's what the IRS considers an audit trail, and keeping those receipts for the credit card statement, your debit card are key. There are situations in an audit where they can disallow those expenses if you don't have the receipt. If you go to Office Depot or Home Depot, they don't know if you're buying stuff for your home, your office, so they want to see that follow-up documentation from receipt to statement to your financial statement. You can see those kind of 3K pieces coming together. And that's really about having a strong audit trail, which then helps you have mistake number 2, a strong accounting system in place. Then you're getting a financial, you're not just managing the company by the checkbook, and you got good, strong organization, operational controls between the accounting and the reporting system. So there's no mixing of business and personal, and it's very clear which one is which. The other thing is, when you start mixing that personal stuff, you're going to mess with your dials, you're going to mess with your numbers, it's going to distort things. There's some other challenges that can pop up in really extreme situations with mixing business and personal in the IRS as well, with sometimes it piercing the corporate veil. So we really want to have good organization and keep those things separate. So hopefully that touches on, that'll help put a little bit of context how some of these mistakes can get in the way of us getting the information we need and making the decisions we need to lead ourselves or have some influence over our situation and our results. So awesome, great. If you do have any questions again as we go, feel free to put them in the chat too. And good, we don't have anything yet, so great. Just want to keep on checking in on that as we go here. And all right, perfect. We're doing great on time. So let's briefly talk about this first scorecard, and I'm going to put the balance sheet up for you. And also, so you guys know, I'm going to start actually on page 7 in the book for a moment. We're going to start with this scorecard, and it's called our balance sheet. And let's cover what's on this scorecard, and then we'll talk about briefly why it's called the balance sheet and why it's important. So what you're going to see on there on the left-hand side is all of our stuff, like cash, accounts receivable, inventory, and equipment. Now, receivables aren't as prevalent in the restaurant industry. Sometimes if you do catering as well, that can be more prevalent, but inventory is a huge one, right? With managing food costs and things that come in. And then obviously all the equipment that we're going to need, either inside for the build out or the kitchen equipment or the bar and everything that goes into, building a restaurant and the infrastructure that you need to be able to operate. So that can be a big one there as well. And that's just really all of our stuff, right? Cash, inventory, equipment. It's our stuff we're going to use to eventually be in business and generate sales. Now, ultimately, all of our stuff, whether it's equipment or inventory or whatever it is, we either owe or own our stuff. And that's the key part. So this part on the left, cash, receivables, and inventory, is all of our equipment. Let me actually just try to see if I can, there we go. And so this is all of our stuff. So you can write stuff like right above here on the left-hand side. And on this side, AP, credit cards, taxes payable, notes payable. We'll cover those again here in a minute. But that's all stuff that you can owe, right? AP accounts payable that you owe to vendors, or your credit card payable that you pay at the end of the month or pay off over time. Your taxes payable are key. There's an infinite amount of taxes, it seems. I mean, there's payroll tax, there's taxes, unemployment taxes at the end of the quarter. There's sales tax. At the end of the year, there's business personal property tax, and then there's also the property tax if you own a building. So there's a lot of different taxes that can add up there. And then there's also note payables, right? Note payable is something that's long-term, greater than a year, has an interest rate, has a contract involved, a repayment schedule. And that's different than an account payable. That's like short-term to vendors over 30 days, maybe 60 days, depending on your terms, right? So that's everything that we can owe, right? We might go out and buy equipment. We might have a small note on it, so we owe on it. Or maybe we go out and buy equipment and then we paid cash for it, and then that is what we own, this section right here. A business owns the investments and the profits of the business, right? If you put money in as an investment to start, like you purchase stock, for instance, that money's in your business. And since you're a controlling shareholder in your business, you can move that money around as you see fit. Like if you were to invest in Apple, though, right? Once Apple has that money, they own that investment to do what they see fit with it, with those resources. Then a business owns the profits. And to keep this simple for right now, there are actually two types of profits. And you'll see this more in a moment when we talk about the profit and loss statement. But there's the profits from the current year in the current video that we're watching. And eventually, when a business has been around for more than a year, it also has something called retained earnings, which is then the cumulative combined profits of losses of the business throughout its entire lifetime in existence. So once we're through year one, there can be a category that says profits and then retained earnings to allow us to know how much of the earnings of the business are we keeping in the business. And that's more detail than we need right now. But the point is, again, the business owns the profits, whether it's from the current year or the prior year. And this distributions bucket is simply keeping track of how much of the profits have been distributed back to the owners or the shareholders. Now, also, by the way, depending on what type of entity you are for the IRS, a sole proprietor, partnership, S Corp, or C Corporation, the IRS has a couple different terms that they can name for distributions, like draws or dividends. They're all the same thing. It's just keeping track of how much of the profits have been distributed back to the owners. So again, we got our stuff on the left, what we owe here with accounts payable, credit card, taxes, and notes payable, and then what we own here. And we either owe or own our stuff. And we'll see that more visually in a moment. But those are the key details that are on our balance sheet. Now, if you have any questions on that, as we go through, we're going to go to the income statement now. So if you do have any questions, just pop it in there so we can keep track of it. You may not. So hopefully I'm sure we're doing great here. The next one's the profit and loss statement. And by the way, it's drawn like this for a very specific reason, because this is the one number every single person's looking at every single month. And what we're going to see on here is it's sales minus 4 key expense categories. So you might have your food cost, your labor cost, and then also in some restaurants, your chart of accounts is just essentially all your buckets that you're going to have to monitor sales, your food cost, labor cost, or other expenses. So you might have your main section for food cost, labor cost, and sometimes businesses, these controllable expenses and non-controllable, all just get lumped into operating expenses. Some restaurateurs like a little bit more detail with it. They like breaking those things out. I also know some other very successful restaurateurs. So for instance, with controllable expenses, these are things that can somewhat be controlled by management and personnel by means of following a budget. Examples can include lemons, chemicals. Preventative maintenance is another one that might occur on a routine basis to avoid large costly breakdowns. And so sometimes people like that level of detail of looking at the controllable expenses and then the non-controllable, which are more like occupancy, rent, property taxes, insurance, interest, and things like that that are less controllable. And even some of these times with these controllable expenses, depending on what your preference is for your level of detail. I remember talking to a very successful restaurateur that, it's like even with some of these controllable expenses with rationing, things like linens and chemicals, there's kind of a limit at some point to how much you can do with that. It's important to monitor those line items. So that really just gets into how do you want your chart of accounts set up, and how do you want to look at your business in terms of the profit and loss statement, and depending on your preferences and what you want to see, there can be some modifications to how some of this shows up on the financial to give you the information that you need. But to keep it simple, everything really fits into either those 3 or 4 categories. And then what we have is our bottom line profit here. That's the number everyone's looking at every single month. Now, just to plant the seed on something here, the balance sheet and profit and loss statement are the main 2 scorecards that every single person is going to receive in their business from their accountant or from their QuickBooks. There is a third scorecard called the cash flow statement. And one of our mastery classes, we spend literally a whole morning, 2 to 4 hours, laying all the groundwork to help people easily read this statement. But it does take a little bit of going down that path to be able to thoroughly understand it. So the important seed is here is, when we were on that cash flow track, remember there was a part for between sales and profits. But notice all those other parts on the track between financing and assets. Cash can come in and out of our business other ways, besides sales and expenses that are on the profit and loss statement. The cash flow statement keeps track of those other items for you, because like for notes, for instance, as we talked about, right? You borrow money from the bank, that doesn't show up on the profit and loss statement, it shows up on the balance sheet. So cash comes in. And then when you repay it, right, the repaying the note payment isn't an expense on the profit and loss statement because it wasn't sales or revenue. So, right, it's going to reduce your note payment, it's going to eat up your cash. This is just one example. Your cash flow statement answers these questions. It keeps track of your sales and expenses, because where your profit and loss statement ends, your cash flow statement begins. Things like when you purchase inventory can impact cash flow. You buy and sell equipment, you borrow or raise money or repay it, or you make distributions. All of these things, to keep this simple for the moment, this is just a seed, are items on the balance sheet that can use or generate cash. And the cash flow statement helps us answer the question of how do we get from our profit position to cash position. That's why when people look at this one number every month in the bottom of the profit and loss statement, the real next step is then to look at how are you generating cash from operations, investing activities, and financing activities, and how did you arrive at ending cash? So just a little bit of a seed with that. Next, a couple other things of how these statements come together here. You got some images up here. The balance sheet's going to say as of January 31st, as of December 31st, because it takes a screenshot at a point in time, or a snapshot. It takes an image, because after you snap the screenshot or the image, right, the picture changes. Cash never stays the same, right? Receivables change, payables change, your note payment can change, your distributions can change during time. So all we can do with this balance sheet is take a screenshot at a point in time, which is the end of a month. Then our profit and loss statement and cash flow statements are like videos. They are both going to capture all the activities from the beginning of the month, the end of the month, beginning of the year to the end of the year. And they don't say as of at the top. They say for the month of, because it's capturing everything during that period, or for the year of, or whatever period you're looking at. So again, the balance sheet's like a screenshot. The profit and loss statement are both like videos, showing you the entire story, the entire movie from beginning to end, so you can get the whole story. Also, with what we've talked about, right, our balance sheet's got our stuff on the left. We either owe or own our stuff. And those are simple, plain English words for you, right? Some of you may be familiar. Accountants, right, their business lingo, and Warren Buffett will tell you, the language of business is accounting. And if you can't speak the language, you can't really tell how you arrived at cash in the checking account and what you need to do to shift things the next period to be able to have more influence over your situation. So we got all of our stuff. And then again, we either owe or own our stuff, like a house. For instance, if the house is worth 100 and you got 70 in equity, you still owe 30 on the mortgage. You can see the left-hand side equals the right-hand side, because again, we either owe or own on it, and that equals our stuff. Now, while the balance sheet will tell us whether we owe or own our stuff, which can be very beneficial, and why a bank wants to look at our balance sheet as well, can help us understand where we're at a position with that. We also need a balance sheet from an accounting perspective to know that we accounted for all cash that comes in and out. It has to do with kind of how our accounting process it works, but it's the only way to actually make sure anything that shows up on the balance sheet or profit and loss statement is accurate. Some of you may be familiar with what a bank reconciliation is, end of the month, as exciting as that can be about accounting. But the profit and loss statement is going to tell us how profitable are we. And the cash flow statement is going to tell us where the cash. And what's important is all three of these stories help make up our entire story. How much debt do we have? Do we own a lot of it? Have we built up equity in our business with our balance sheet? Even if we're profitable, are we then converting those things to cash on our cash flow statement? If we have some debt, even if we're profitable, are we going to be able to also repay what we owe on those loans? as well, or if we need new equipment. So again, we either owe or own our stuff. It's how profitable we are in the profit and loss statement. And then are we converting those profits into cash? And it kind of also just go back to bring this full circle to what we talked about here on our cash flow track. You know, the balance sheet's right up here, financing and assets. Profit and loss statement is right here between sales and profits. And right here between profits and cash is the cash flow statement. So each one of these scorecards will come together on a different part of the track to give us some financial information to help us make decisions about how to allocate financial resources, which has been more important now than ever for businesses. So with that said, that kind of brings that part full circle for you. And let's to bring us back to this is okay. Also real quick to touch on it. Out there, and if you can real quick in the chat, do you think your profit and loss statement is a fact or a theory? Let's just give you guys like 20 seconds to put an answer in on chat. Do you think your profit and loss statement is a fact or a theory? Fact or a theory? We got a theory. Thank you, Danielle, if I'm pronouncing that correct. Anne, that's my mom's name. That's great. You said fact. Oh, Emily, we got some advanced accountants out there. She says it depends on if you're cash or accrual basis. You are a rock star, Emily. And also for any of you that want to join us for some of the other classes like cash flow essentials or cash flow fundamentals, we're going to be able to jump into some greater details like she's talking about there with cash or accrual. In an hour here with the runway, we want to be thorough with what we're covering and not try to cram in too much information. But those are some of the next steps. And she's absolutely right on that. That is one variable that impacts the numbers that show up on the profit and loss statement. And if anybody else got an answer, put it in there. But to build on that, the profit and loss statement is a theory. It is a very, very important theory. And it's a theory. But it has nothing to do with, thank you very much, Iris, for putting that in there. I saw you had, I think, I didn't, let's see what you got here. You put theory. Great answer, Iris. Thank you very much for your participation on that. And it's a theory, and it's a very important theory. And to keep it simple for now about why it's a theory, here's how to look at it. The point of the profit and loss statement is tell us how much do we have in sales, how much do we have in expenses, and if so, how much profit is left over, or if so, there's a loss. And to be able to accurately allocate our expenses to our sales, here's a quick example. Let's say we own a little pizza place, and our pizza oven breaks down today. So tomorrow, we're going to go out and buy a pizza oven for $6,000 cash. Now, that pizza oven, by the way, is going to be good for 5 years of generating sales and revenue. And let's just say our small little pizza place does $10,000 in sales a month. So on an annual basis, it does about $120,000 in sales. Now, if our pizza oven's good for 5 years, that means $600,000 of pizza are going to come out of that oven over a 5-year period. Because again, 10,000 of sales a month times 12 months is 120,000 a year times the 5 years the pizza oven will be good for. It's about $600,000 of revenue our $6,000 pizza oven will support. So even though we're going to go out tomorrow and pay cash for this, if we were to expense the whole $6,000 in the month of November, and for the month of November, we're going to have $10,000 of sales. If we looked at our financial statement in November, would that be an accurate reflection of the expenses it took to support a certain amount of sales? Anybody in the chat can put yes or no, depending on what they think there. But the answer is no. The answer is no. And what accountants are really there to do is help allocate those expenses, in this case, the piece of equipment or depreciation, for instance, so that they can spread out that expense over that 5-year period, which if you do the math, 6,000 divided by 5 is $1,200 a year, divided by 12 is $100 a month that will be expensed over a 5-year period. So over 5 years, they'll expense the full $6,000. Now, that's what's going to show up on the profit or loss statement. but that's a way to accurately look at how much did it cost in expenses to support a certain amount of sales. But notice that doesn't necessarily have to do with what happened to cash. We spend $6,000, we're going to spend it tomorrow. But how that then shows up on the profit and loss statement based on the theory of how to allocate revenue and expenses. And that's why Emily was totally right. There's different methods of accounting with cash or accrual, and we'll come back to that in just a moment as well. And so it's a very important theory. But actually, just to jump to that with the comment that Emily made, is if we go to this slide here, now that we've talked about the balance sheet, accrual accounting simply means when, regardless if cash is paid out or received, we're going to record it as a sale or an expense. So if we've provided the services or the expense has been incurred, we're going to account for it. So essentially what that means is we're going to put receivables and payables on the books. Now, to be clear, if somebody's on cash accounting, it doesn't mean they don't track receivables and payables. They just don't make their way onto the official scoreboard. It's kind of like a baseball game, right? There are certain key numbers that you put up on the scoreboard that everybody can see. And then there's other numbers that are kept like in the back office or those quick stats the commentators can pull out. You're still going to have those somewhere, just a matter of whether those are being put on the financial. There's also some other dynamics from a tax projection and things like that too. But cash accounting just means there's no score. Like in this case, if our sales were all receivables of 10,000 or expenses were all expenses that were payables of 5,000, in accrual accounting, we record all that, even though we haven't paid out or in any cash that's got paid in. Cash accounting says, you know what? No cash in and out, no score. So those things can all impact the theory of how we're looking at our profit position. So perfect. So that kind of helps bring that home. And what's also important about this then is the cash flow statement and your cash balance on your balance sheet are fact, right? You can't argue with cash in the checking account. You know, if you want to call the bank and try to have that conversation, I guess let us know how that all is going to go. But the reality is cash is a fact. You know, when you look at your cash flow statement, get familiar, look at your balance sheet with cash in it. This is what came in. This is what went out. End of sentence. You can't argue with that one. So profit and loss is important, but it's a theory, but it doesn't have to do with cash. And that's really why the balance sheet and the cash flow statement are important to know how we arrived at that cash position. Because going back to our cash flow track, whether we're paying off debt or buying new equipment or putting into sales and marketing or distributing that money out, all those things impact cash on the balance sheet, but you're not going to see those numbers show up on the profit and loss statement because those are just sales and expenses. Okay. All right. The other thing is how these come together real quickly is the profit and loss statement, right? This number here is this number here up on the balance sheet. And I know we didn't talk about the cash flow statement in detail, but that ends with ending cash. And that's the same as the cash number up there. And that's how these come together. And also where your profit and loss statement ends, it ends with your profit. And then we'll tell you how you got to the ending cash position. And notice, by the way, on our balance sheet, you see cash here and our profits here. All those other balance sheet items are what impacted cash, which explains why our cash position and profit position are two different things, and everything in between that impacts it. And again, those are just some seeds on that. And you guys, as part of the Wisconsin Restaurant Association, are welcome to join us for like Cash Flow Essentials or one of our Cash Flow Fundamentals class, where we do spend a lot more time and energy really covering this thoroughly. Because as I said, it can take a little bit of time, and that's why we spend a morning on it to really become masters at navigating, understanding these tools. So you can kind of just see that visually with how they come together. And again, this is the financial GPS system, and these are your routes. If you want to know how you got to your cash position, you go to your cash flow statement and follow it down. You want to know how you got to your profit position, you go to your profit and loss statement and follow it down. And that's how all three of these come together. And again, our main focus has been on the balance sheet, the profit and loss statement. And those are just some important seeds to plant with the cash flow statement for right now. Okay, next. And here's also kind of to help bring this full circle. You know, we talked about with the 5 critical accounting mistakes that a lot of businesses are running their business by the checkbook, which means the only number they're looking at every day is how much cash in the checking account, which, by the way, is a habit and a ritual every business owner should do. looking at how much cash is in their account every day and where they're at. And think about this with everything we've talked about, with the information on the balance sheet, our profit and loss statement with food costs and labor costs and operating expenses and all the other things that it can impact cash along the cash flow track. It's one thing to manage your business with these tools, but then, if Walter's kind of trying to figure out where he's going to go, think about this for a moment. No cash flow statement, no profit and loss statement, no balance sheet. And now we're just back to that one number where we all started on the balance sheet. You can really see how these other coordinates on our financial statement are important. So eventually we can look at our financial statement for a little bit, read and understand our numbers, know where things could be improved, what was off track, know what areas of our business we need to go manage a little bit more properly, whether it's scheduling or inventory or our operating expenses, or relook at refinancing our notes or equipment purchases that are going to be coming up. It helps us understand and allocate where those resources have been allocated, what was spent or what was not, or where money came from and where it went. So you can really get a good idea of where the cash drains and leaks are, again, to have more influence over your situation. We never have control necessarily, but this does allow us to feel a sense of control with the influence we can have over the numbers. And that again comes back to what we talked about with implementing a numbers-based strategy, right? We know our desired financial destination with food costs, labor costs, based on the type of restaurant you have. We're going to get into more detail, and you're going to get a great handout next time with that, right? Then we have to go out and navigate the territory, our bank statements, credit card statements, produce transactions, accounting piles all that information together, organizes it at the end of the month. We create our scorecard. We understand the story. We compare that to where we want to be. And a good example of that with a restaurant that we had a long time ago was for 2 months in a row, his food costs that went up by 1%, 2% increase over 2 months. And he had determined in that third month that it was a permanent increase in the cost of him doing business. So he went down that month, reprinted his menus, adjusted his prices, and sure enough, the next month, his profitability got back in line. That is an example of, reading and understanding your numbers, implementing a numbers-based strategy, knowing what's off, knowing what to improve, making a new decision, and then taking action to be able to improve your situation. I remember this was a couple months ago at a golf outing, talking to a restaurateur, and some of you might have already experienced this. He had already increased prices twice this year, especially with everything going on around that. So sometimes that's not the lever, sometimes it is. And we're going to talk about that in more detail next time. Today's main session was getting familiar with these maps and navigating them, and then we'll be picking certain numbers off them next time to help you understand how to utilize the numbers. Today was kind of getting familiar with the maps. Next time we're going to actually put them together for you in a quick formula for some break-even analysis and resetting sales goals and be able to adjust based on a lot of the dynamics that have happened. With that being said, let's just quickly, so we're good on time. We just got about 5 minutes left here. And, let's do this for a minute. Oopsies. 1 second. Okay. We're going to, just to kind of streamline through a couple of these key principles here with key performance indicators, which is where we're going to pick up next time. The purpose of this slide, if you're at home, right? Because sometimes when we have a pattern, right, we see 1, 2, 3, 4, 5, 6, and being able to just touch base with our numbers at the months can allow us to clarify and verify. Because every time something every once in a while, something can interrupt the pattern. And being able to just quickly checking back with our numbers can just make sure everything's on track. The patterns we need are where they need to be, or they're improving, right? And this was obviously something that interrupted everyone's pattern and everyone's numbers. And just being able to check on and know what the facts of the situation are, because in the ups and downs emotionally every day in our business, our numbers can actually ground us into reality. So often we're afraid of them, but they tell us where we're really at to be able to allow us to understand what's our roadmap for the road ahead. And that's why this session was understanding our roadmaps and our financial GPS system as a metaphor, right? With our balance sheet, our profit and loss statement, and touching on the cash flow statement. And then the next one, setting and resetting sales goals, is designing the roadmap. So this is where you are at point A, based on where you're currently at, and you want to get to point Z, what needs to shift? And we're going to figure out a very easy formula that you can utilize to be able to make those decisions and understand what those numbers are. And play along at home with me for a minute. We'll get through this quick. What is that? It's a dot, isn't it? And so is that, and that, and that, and that. And what you notice over time is enough dots make a picture. And that's also why next time, and quickly here, we're just going to talk about a few KPIs, because, you know, with about, for a restaurant, really between about 5 key numbers: your food cost, your labor cost, total operating expenses, your average dollar purchase, and your number of transactions. Those are really your 5 key numbers to monitor and your entire performance. Yes, there are a lot of other numbers there, but those are the key ones, because enough of those dots make a picture about what's going on and leading to the end result. Like, I know, for instance, one franchise in Milwaukee, this was a number of years ago, so the number might have slightly changed. They knew with their franchisees, they had to have an average dollar purchase of $10. If that number was off and the transaction size was off, sales would be off. And if they didn't keep food costs to, in that particular restaurant model, it was 30%, didn't keep labor cost to 28 to 30%, because the other thing for them, they had to make sure between food and labor cost, it never exceeded 58%. They knew if one of those two numbers were off, profitability would be off. But oftentimes it's 3 or 4 numbers that are really the key to the rest of the results. The other ones are important. Sometimes we got 4 or 5 items that are off by a percentage or a half percentage, and those percentages can add up pretty quickly. But enough dots make a picture. And this is an example. What the key performance indicators are is taking the number and turning into a percentage, because it helps us understand the relationship. If sales are going up or down, our ratio of expenses staying the same. So like, this is a business, right, that at 100 in sales, 80 in expenses, $20 left over, 20%, versus this one that did 1,000 in sales, expenses of 90, and 100 in profit. Sure, they had a higher number on there, but the percentage was 10%. And that's why we really want on our profit and loss statement all of those percentages for food and for labor cost. And that's partly what's going to go into our break-even equation and building profit into our break-even next time, and resetting and kind of establishing benchmarks on that. But you can see that's really just the relationship of profitability to sales. Also, just to impact a couple other things to demonstrate the power of monitoring food cost and labor cost. So this is sales. This is a fancy COGS, cost of goods sold. The gross profit left over after the direct expenses for food and labor. And then just we're lumping everything into operating expenses. But, for instance, if you sell it for 10 and it costs you 6, and your gross profit's 4 and your operating expenses are 4, you break it even. But if all of a sudden you produce a second unit and it's not 6 per unit, it's 8. So your cost of goods sold goes to 60, and so it goes from 60 to 80, that 20% increase. Your sales have been 20, cost of goods sold 16, gross profit still 4, operating expenses are still 4, so your profit is 0. Meaning on double the sales, it wiped out your entire bottom line. Double the sales, 33% increase in your cost of goods sold, wiped out the bottom line. What it should have looked like was 20 in sales, 12 in cost of goods sold, 8 in gross profit, 4 in operating, and then they have $4 left in the bottom line. This slide is really just to highlight the importance of managing food and labor costs. And the other thing real quick, this slide is just to help give us an example of the importance in pricing, right? We got the same on the left, 10 in sales, 6 in cost of goods sold, 4 in gross profit, 4 in operating expenses, profit still 0. But let's say you didn't have it priced right. It still cost you $6 to produce, but now you're selling it for 8 and not 10. So now if you sell 1 unit, by the way, and I apologize, I should say 1 unit on top here, but you sell the first one for 6, it cost you 6, you sell it for 8, my apologies, $2 left over on the gross profit, not 4, operating expenses are still 4, and now you're losing $2 on your first unit, So this just demonstrates the importance of making sure it's pricing and managing those key cost structures. And that's really where we're going to pick up on next time. So with that being said, and we want to turn it over to Amy here in a minute, remember, today was about keeping it simple. Sometimes putting this into practice is not always easy, but it is worth it. because once you get familiar with it enough, it will be like looking at a financial GPS on the phone. You'll look at some key numbers. You'll say, this is where I want to go. And then you'll know at least what, activity you need to produce in terms of managing food or labor cost or average transaction size or the number of transactions. So then you can jump back in your business and know what to manage to lead yourself and your team to your results, because, simple is much better than complex. So the day was to make it simple, get you familiar with this. I want to encourage you between now and the next session, pull out your balance sheet, pull out your profit and loss statement, get familiar with navigating these numbers. Then the next time, if you want to even bring your profit and loss statement, or after the next session, you'll be able to understand how to utilize a couple key numbers there to set and reset sales goals and profitability goals. And then we have the other session later in December about how to work with your team and make that even more powerful, than be able to help lead yourself and the team to the results. Other couple things just to emphasize here, we are here to help you. So if you have questions or you want to know how to practice this or implement this with some of what we talked about, you pull out your balance sheet, your profit and loss statement between now and the next session, and you just need some help navigating, please call us. We can figure out a time to connect with a strategy session, make that available to all of you, and get those questions answered so you can really understand the numbers of implementing a numbers-based strategy. We also have a lot of other resources on our website with our essentials and mastery classes and the articles I mentioned on our website, and connect with us on Facebook and LinkedIn. We have a lot of great posts and resources that we put out there on a regular basis. We want to be able to stay in touch with you. And just again, to emphasize, we are a phone call away, and Amy will pass that information along in a further email. But we really want to emphasize that we are a resource here to support your success. I really hope you enjoyed our session today on understanding cash flow 1, 2, 3. I hope our pace was good today. We kind of remodified some things, be able to enhance your learning experience and cover what we did thoroughly and give you a great foundation, so that when we get to our next session, we can start really putting this into practice and running some easy numbers and implement this numbers-based strategy. So thank you so much. And Amy, if you want to take it from there, and then also we can open it up for questions with anything that's left there too.
Sounds good. Thank you, Joseph, so much for leading our session today. And I appreciate our partnership we have with the EWH Small Business Accounting and the support for this 3-part series. So I look forward to having Joseph and everybody joining us again on Monday, November 29th at 9 a.m. For that session. The December session is again at 2 o'clock, but the next one is 9 a.m. So I know it is 3 o'clock. So Joseph and I are going to hang on for a moment to do a little Q&A. We understand that some of you may need to get back to your restaurants, but so we're officially concluding right now, but we're going to hang on for just a few minutes. And I do see that there is a question here.
And just also to encourage it to anybody that does have to go, when Amy sends out the email tomorrow, if you have a question, please send it over to us. There was a great question from somebody before our session. We want to make sure those get answered. So perfect. And what was the let me just look. Oh, I got to pull it up here.
Yeah, I can read it out loud here. We have, what are the 5 key numbers again for the KPIs?
Yep. So the main ones, and we'll talk about this more next time, and actually how to develop your roadmap for that. So the first one is your food cost, your labor cost, and just your operating expenses as a whole, looking at those key percentages. And we will talk about this more, and actually we have some numbers based on the type of restaurant you have, but there can be some fluctuations there. To keep it simple, generally speaking, a restaurant's bottom line can be 10, sometimes maybe 12, 15%, but a lot of them fluctuate between 10, 12, some are even 8 to 10. So generally speaking, between all the food and the labor cost and the operating, it needs to end up in that number. And then based on what type of restaurant you have, it'll kind of determine what those numbers need to be. That we're covering more next time. Those are the first 3: food cost, labor cost, operating expenses. The next 2 are your average dollar purchase and the number of transactions you have a day or week or a month. Those 2 numbers you get from your POS report. That's managing sales activity. Food and labor costs are managing scheduling and inventory, the day-to-day stuff. You manage those 5 key numbers, it'll be much more likely your profit lands where you need it to be. And what's important is I really appreciate your question. You're anonymous there, because if you can be in touch, you can be in touch with those numbers, and you can track and measure them and know where they are. You can know what to kind of adjust for as you go, again, to have more influence. So thank you, Anonymous out there. I appreciate your question, as I'm sure everyone else did, to highlight that.
Another question, what time is the session the 29th? 9:00 a.m. on Monday the 29th.
You know, and I'd also encourage you guys on that, not only attend the next session, but, you know, once this link goes out, go back and review what we talked about today. That could be really helpful for you as well. So this 3-part series is going to give you not an opportunity to learn, but practice utilizing some of this muscle. It's a critical business skill and tool that'll help you just arrive more at your financial destination, because we're all going to arrive somewhere at the end of the month. Cash in the checking account, profitability, sales, it's just a matter of where. So these tools can help give us more influence. Any other final questions?
Well, just give it a second here. We don't have any in the queue at the moment, but last call here for everybody.
Not for alcohol.
It's almost happy
if
hour.
If it wasn't for daylight saving time, would it be 2? No, it's just.
Anybody else? Well, we have Joseph, but again, I will include Joseph's contact information as well as a link to the session, most likely sometime tomorrow. So you'll have everything you need to get back in touch. Otherwise, we'll reconvene on the 29th. And I think we will officially conclude. So thank you again, Joseph. I look forward to seeing you again soon.
Thank you, Amy. Thank you, the WRA. You are all rock stars. Thank you to all the rock stars out there for showing up and investing in your own learning and growth today. It is an honor and a privilege. We're grateful that you chose us to continue your education with, and to trust us with information you're going to use to make decisions that are going to impact you, your business, your team, and your family. So we really appreciate it and are grateful for your time and energy. It's the most valuable gift you can give to all of us. Thank you so much.